So the last few days, I've been getting long emails from a podcast listener, and he's been asking for my thoughts about the Eurodollar University from Jeffrey Snider that he's done for free on Macro Voices, currency swaps, liquidity injections, repos, reverse repos, QE, things like that. So I have talked about the Eurodollar in the past. I've given a lot major props to Eurodollar University. I've also talked about currency swaps at length. However, I haven't devoted an entire show to it, so it would be easier to find in search for Eurodollar. So before I provide any criticism to Jeffrey Snider for Eurodollar and provide a brief summary about Eurodollar University, and first of all, I highly recommend taking the time, the 6+ hours, to go and listen to the in-depth research that Jeffrey Snider provides over there on Macro Voices. It's free, and there are very few people in this world who know as much about the Eurodollar as Jeffrey Snider does, and who will also talk about it at length for free. Most of the people who know that much stuff about the Eurodollar, they're getting paid a lot of money, and they won't give away that type of information for free. Okay, I will also talk about a summary of the Eurodollar, and rather than writing emails back to this listener, who I think has very valid questions, it just takes too much time to type on my fingers, and I have arthritis, pretty bad arthritis already in both my hands and wrists and fingers, and it's just easier for me to do a podcast about this, an entire show, and get a couple bucks in advertising revenue about this. So, first of all, I think the biggest mistake that Jeffrey Snider makes, and I think he's brilliant with Eurodollar, is unfortunately he frames all of his analysis about the global economy, all of his analysis about things, including the gold market, within the Eurodollar frame. And Eurodollar is, Jeffrey Snider said, so I'm going to use his research, a $15 trillion market. Okay? And we don't know the exact amount of over-the-counter derivatives that is based on that $15 trillion, but $15 trillion now, guys, in the whole scheme of things is not really that big anymore. Okay, and I'll talk about this later in the show. But I think it's a mistake that Jeffrey Snider makes to frame everything, whether it's the gold market, the global economy, certain bond markets, certain banking systems, all within the Eurodollar. And this is because after 2008, the rules changed a lot, and I think there's a lot of evidence that currency swaps have replaced the Eurodollar for liquidity injections. Currency swaps are actually enormously larger now than the Eurodollar market. And we know this from the one-time partial audit that Ron Paul got with congressional approval from Democrats and Republicans. One of the few times that Bernie Sanders and Senator John McCain could actually agree on anything was actually a one-time partial audit of the Federal Reserve. So let me talk about a history of the Eurodollar first, because like I said, Jeffrey Snider's work is good, and I think we should definitely give him a lot of respect for it. However, the mistakes he makes are framing everything, and the Gold Antitrust Action Committee, or GATA, has come out and they have criticized him as well, that Jeffrey Snider has repeatedly tried to frame the gold market that the Eurodollar affects the gold market. And there's been a lot of research that the price of yen, the yen currency trade, the yen carry trade, whether it's the RMB or the yen, in the past have affected the gold market more. Jeffrey Snider does not acknowledge this. He says the Eurodollar affects the gold market the most, and that's all he wants to see. He has Eurodollar colored glasses. That is his perspective. And the Eurodollar is important. It's one piece to the puzzle. Okay, it's one piece to this global economic liquidity puzzle. And this is why this show is called Eurodollar Currency Swaps QE in China. Because in a lot of aspects, those are the main sources of liquidity since the 2008 financial crisis and the rules changes. Okay, those are the new, basically, liquidity pumps. Although the Eurodollar is nowhere near as large now as what China has done and the QE programs and the currency swaps. The currency swaps are the king of liquidity injections along with QE. Okay, so brief history of the Eurodollar. I'm not going to spend hours and hours talking about. I'll spend a couple minutes just on a summary. For those of you who are unfamiliar, the Eurodollar started in the 1950s and 60s. It was European banks who wanted to start a offshore, outside of the United States, dollar borrowing program for other European banks and for foreign corporations outside the US so they could more easily do trade in dollars and transact in dollars and borrow in dollars. And This got around the international gold standard that the U.S. was still on. Remember, U.S. citizens could not own gold back then, but foreign countries could still convert into gold until Nixon closed the gold window. What was it, 1971? So the eurodollar sprung out of bankers' greed, a combination of bankers' greed and the fact that the dollar was the world reserve currency, and they wanted to make it easier to facilitate trade in dollars. However, they were violating the rules because they were creating more money and credit than was supposed to have been allowed under the International Gold Exchange. Okay? And the eurodollar market, it took decades, but the eurodollar market started off small, billions of dollars, not too much, tens of billions, and over many, many decades, it got to the size that Jeffrey Snider talks about, around $15 trillion, and then it broke. Jeffrey Snider says it broke in 2007. I'm not going to argue with him about that. Jeffrey Snider has spent an enormous amount of time learning about this. I do not know if Jeffrey Snider spends a lot of time studying other things about the global economy. In the interviews I've heard him do and the research I've read from him, he tends to try to stick all of his analysis into Eurodollar perspective to try to fit everything. It's like sticking a round peg into a square hole, or a square peg in, or a square peg into a round hole. Okay, the reverse of that. He tries to stick everything incorrectly. And the liquidity, okay, back to the eurodollar. Sorry, got a little off track there for a second. The eurodollar just got crazy at one point, and what happened was American banks, right, saw that the European banks were making crazy amounts of extra profit in Europe with this offshore dollar market. So they started opening up European branches, larger ones, and they started copying the European banks. And then on top of that, what happened was they started using U.S. treasuries for collateral to try to do crazy amounts of leverage in the system. So the people who say that QE is not inflationary, to be honest, these are smart people, but they do not understand how the banking system works. They do not understand fractional reserve banking. I have interviewed Nomi Prinz many times over the years. She was a managing director at Goldman Sachs. She was inside of Goldman Sachs and Bear Stearns. She knows a lot of the things that go on inside a high-level investment bank. In fact, she told me that a lot of the people at the top of Goldman Sachs still would make fun of her for leaving because it was such easy money. But once you have reserves in the banking system, and this is where the Federal Reserve people try to say that QE is not inflationary, that it only creates reserves, but the fractional reserve banking system, once reserves are created, the banks are allowed to do a bunch of different things to start creating loans, to start making bets. They can use those treasuries and interest on reserves, which grow their reserves, as collateral for a bunch of things, whether it's betting in the derivatives market, whether it's betting in options market, whether it's betting on commodities or other things, whether it's giving out loans to hedge funds or carry trades for large currencies with leverage to hedge funds, things like that. Or they could actually do regular banking. They can actually expand their credit, money and credit supply with fractional reserve banking and actually give out loans, which the banking system really has not done a good job of, except for in the United States shale oil. Okay, so to say that QE is not inflationary, it's total bullshit, because once those reserves are created, the banks can then start leveraging that up, and that creates more money and credit for them to make bets, loans, stuff like that, trades, all those different things. So the eurodollar market, it took decades for it to get just enormously large, into the trillions. And the eurodollar market, in perspective, like I said, $15 trillion compared to everything now, not really that large. I pulled up the new research report that came out yesterday from Yardini Research, and he tracks, this is free if you want to go to Yardini, Yardini, and he tracks global central bank balance sheets. And so global central bank balance sheets, this is publicly stated numbers. This doesn't count a bunch of stuff off balance sheet. This doesn't count currency swap lines, any of those things. And total assets for global central banks since 2008 has expanded. It got as high as over $21 trillion in 2018, and now it's down to a little under 20 trillion now at 19.4 trillion, according to him. So there's just an enormous explosion in central bank balance sheets, and that's a lot of liquidity. Danielle DiMartino Booth did an interview with Jeff Gunlock and then another long interview with Keith McCullough of Hedgeye. And I strongly recommend you take a look at both. And people ask her, well, what has changed with the global economy? Why did this stock market crash in December and then rally so strongly? And then she said, quote, it's all about liquidity, end quote. And then she talks about how basically the Chinese government stepped in because their stock market was also doing very bad, along with the U.S. stock market. Their stock market had been doing worse, I think, actually, on a percentage basis than the U.S. stocks did before the Christmas Eve crash. And the Chinese government, within a span of a couple weeks only, put in about $900 billion of new liquidity injections in a type of QE program. Okay, there's articles about this. There's interviews with Danielle DiMartino Booth talking about this. And a lot of that is what reversed the Chinese stock market. And a lot of that is also that liquidity left China and has reversed U.S. asset prices and U.S. stocks. That's why we have not had a crash, is because of new liquidity injections. That was publicly announced. So the real numbers of liquidity injections, we don't know the real numbers. We can kind of make estimates. So the publicly stated central bank balance sheets from Yardeni, let's call it 21, 22 trillion. I don't know if they all sold off all those assets or not. That's just publicly listed. I'm sure there's stuff off balance sheet. So that's give or take $20 trillion. China, in only 10 years, China has created over $40 trillion in money and credit in only 10 years. And all of that credit and money, RMB, has not stayed in China. So that's additional liquidity that has flooded the global economy in real estate markets and commodities, etc. Okay, so there's just been enormous amounts of liquidity flooding the global economy, asset markets, real estate markets all over the globe since 2008. The rules have changed a lot. Okay, so now, before I talk more about China, I just wanted to provide you with perspective that there's been over 65, according to my estimates, and this is interviewing a lot of different experts, studying a lot of different research, what I pieced together to this global economic puzzle, this liquidity puzzle of QE, of China doing money and credit, of currency swaps from central bank to central bank, the euro-dollar market, these other things. Over $65 trillion in new money and credit has been created since 2008. Okay, that is enormously inflationary. And that is why a lot of real economies are in stagflate and lie mode now. And that is why asset prices have not collapsed for the most part, because of liquidity. The money is not going to be held, even though the people who say QE is not inflationary, that the reserves have technically not left the Fed's balance sheet there and they're earning interest on the reserves. They don't have to move the reserves. They just use the reserves as collateral, okay? And then they can start doing loans. They can start making bets. I've interviewed Nomi Prinz extensively about this. She talks about this in all of her interviews. She writes about this in her new book, okay? If you don't believe me, go check out her resources. She worked at the very highest levels, basically, at Goldman Sachs, other than being the CEO or the position right below it. Managing director is very, very high up. And she admitted, and I've had long conversations with her about currency swaps, and she even, for research on her new book, she flew down to Mexico and she flew down to Brazil, and she had long, extensive interviews for her new book with current and former central bankers in Brazil and a former central banker in Mexico who was threatened by Ben Bernanke, and I believe now he's the head of he's the head of the Bank of International Settlements. And these guys actually were very candid about currency swaps and intervention and all these things. Okay, so let's move on now to currency swaps, because I think I've covered euro-dollar enough. Again, if you don't understand euro-dollar, I just gave a very brief summary, a couple of minutes. I didn't want to spend a lot of time on it. I highly recommend you spend the 6+ hours listening to Eurodollar University Seasons 1 and 2. I think it is excellent. And normally people would not get that type of information for free. Normally someone would charge for that. The mistake I think Jeff Snider is making, though, is that he tries to fit everything into a euro-dollar perspective. And like I said, the euro-dollar market compared to the QE programs the central banks have done, how much balance sheet expansion they have, just publicly stated, off-balance sheet stuff the central banks have done, and currency swap lines, the euro-dollar market is not that large. Okay, so now let's talk about currency swaps. So currency swaps, I've talked about this at length for many years now, since 2014, since I got information from my source. And I've been learning and reading and studying and looking for articles about currency swaps. There was an interesting article that came out a few years ago. The People's Bank of China has gotten into the currency swap game. There are only 2 major central banks doing currency swaps, okay? Anyone who tells you otherwise, send me the articles. I have not seen any other central banks doing this. The only 2 ones who are doing these loans, these types of interest-free loans for whatever nefarious purposes, are the Federal Reserve and the People's Bank of China. That is it. And the People's Bank of China, the currency swaps they are giving out are only in the billions or tens of billions range. They are nowhere near the levels that the Federal Reserve is giving out. So currency swaps initially, this was mentioned in a book by James Turk of Gold Money and John Rubino. And James Turk, if you're not familiar with his background besides gold money and talking about the gold market and gold miners, he was an investment banker for many decades, okay? And that's how he got interested in gold. I think he was in charge of some type of gold trading at the investment bank he worked at. And in the Money Bubble book that he wrote with John Rubino, a lot of people did not like the book because they said it was a repeat of a lot of his interviews. However, there was a few good nuggets in there. Pun intended. There's a few good nuggets of information in there. And he talks about how currency swaps started. So the currencies, and these are central bank to central bank currency swaps. Investment banks can do swaps. These are different. And the central bank to central bank currency swaps started in the tequila crisis and the Asian tiger crisis. And they started off normally to help American banks that had made really dumb loans to either foreign banks or foreign governments. And so they were holding bad government debt, and the banks would have either had to take losses or they had too much bad leverage with the debt, and they would have gotten in trouble. So these were covert bailouts. Now, I don't remember, for some of these things, I was either a little kid or wasn't alive. And some of these things were only in the $1 billion range. A couple $1 billion here. That's what they started off as. I'm not sure if they even publicly announced this or not. So basically, you have to find someone who was alive back then who actually remembers that they actually did do the currency swaps, because you're not going to hear about this in mainstream financial media. And so they started initially currency swaps as a couple $1 billion. Then they got up to, I think, around tens of billions in that range for long-term capital management, because the banks had bad bets, and there was I think that was involved with the Russian government, the ruble collapsing. So the banks had bad ruble bets too, because some of them were trying to copy long-term capital management. So there was some currency swap bailouts on that as well. And eventually it got to the point where the people in power decided, after TARP, after changing the accounting laws, after the bailouts in 2008, they decided that the easiest way to inject a lot of liquidity very, very quickly without congressional approval, because the Federal Reserve is not audited, not independently audited. There's no transparency at the Fed. They decided to, and this is unprecedented according to my research, that they had never done anything on this scale before. This is a big rules change, that they decided to implement emergency currency swaps. Now, we did not find out about this until the one-time partial audit of the Federal Reserve that Ron Paul initiated. So you had the banks had the accounting rules changed for them, you had the currency swaps implemented, you had the TARP programs, and you had the bailouts, and you had QE, and a lot of this happened quickly. And if you want to ask the question, well, like, Jason, why is Jeff Snider wrong? Why are the currency swaps larger and provide more liquidity faster than Eurodollar? And the answer is really simple, and we found this out from the one-time partial audit from Ron Paul. We found out that within a matter of weeks, the Federal Reserve injected approximately, and this is not a full audit, so this might not be the real number, injected approximately $16 trillion in currency swaps and interest-free loans to foreign central banks, foreign governments, foreign private banks, foreign corporations, and American corporations. So this, on terms of scale and how fast the currency swaps can be implemented now, I would say that the currency swaps are the king besides QE, and even QE now announcements are getting really negative backlash. The currency swaps are the king of liquidity injections. There is no transparency. It does not require congressional approval. I have not heard a single congressional member other than Ron Paul discuss this or bring it up. So the currency swaps are, after the rules changed, the rules of the game changed in 2008, the currency swaps are now the preferred method of crazy amounts of liquidity injections. And this brings me to my story that I got from a source in 2014, and my opinion of the global economy and how things are playing out changed drastically after I got this information. Now, I've studied hundreds of different experts, and I've questioned my beliefs a lot, and I have changed my opinion on things, because the conventional Austrian school economics stuff is that there should have been hyperinflation already, and that a lot of Austrians, unfortunately, seem to think that China is doing a good job, but they don't. It's really weird how so many Austrian school economists and libertarians defend China based on all the stuff they've done. But anyways, though, the source brought me information. My source was inside a very high-level IMF meeting here in Washington, D.C. in 2014, and there were representatives there at this IMF meeting with long presentations from all the major treasury departments, all the major central banks of the largest economies here on Earth. So there was like 6 or 7 of the largest countries, their treasury departments, their central bankers were all there with long presentations. And what my source said was that the main takeaway, besides the fact that there was actually some mainstream financial media journalists there who didn't care and were actually paying attention and none of this was reported, but the main takeaway was that the phrase currency swaps was used hundreds of times, talking about maintaining the system, talking about keeping things going, talking about protecting Europe, the European Union, European banks. So currency swaps was used, the phrase, hundreds of times in presentations. And initially, I didn't really understand what central bank to central bank currency swaps are, because when you're an MBA student and you're reading investing books, they don't talk about this stuff. Even a lot of the financial professionals that I've talked to don't fully understand this stuff that well. And I've brought this up to the Austrians in finance group, the Yahoo group, with all these hedge fund managers and Wall Street professionals, and they argue with me. They say the currency swap things is not true. They say the currency swap things is not true, and then I say, why not? And then they send me a link to a central bank balance sheet that they claim is being honest and transparent. But the central banks are not honest and transparent. There's not independent audits. And as far as I can tell, the central bank to central bank currency swaps are not carried on the balance sheet. They don't count them on the balance sheet. They count it as having collateral. It's basically an interest-free loan that the Federal Reserve says is going to be paid back. But in actuality, these loans will never be paid back. They'll just be canceled. So if you're not familiar with how a central bank to central bank currency swap works, you have to understand global trade with the dollar system, the dollar standard we have now. So normally for a foreign corporation or country to earn dollars, let's just use Japan because it's easiest. Large companies in Japan like Toyota and Sony and some of these others, right? And Honda, Nintendo would have to produce all of these goods. So Toyota would have to produce more cars. Sony would have to produce more TVs and more PlayStations. Nintendo would have to produce more gaming systems, okay? And in exchange for that, they would earn more dollars, bring them back, okay? That's how global trade is supposed to function in this world reserve currency dollar standard system we have now. Okay, you have to produce more to earn more dollars. That's how it's supposed to function. With currency swaps, central bank to central bank currency swaps, if a country is in trouble, if there's a potential run on a bank, if there's counterparty risk where American banks are in trouble because they have bad loans to a Japanese bank or a European bank, what the Federal Reserve can do now, and this has only started based on my research and my sources since 2008, and it's just gotten out of control. What this has started since 2008 is now if the European Central Bank, the ECB, is in trouble, all they do now, instead of their corporations having to produce more goods and services to earn those dollars, right, to work their asses off to earn those dollars, all they have to do now is call people up at the Fed and say, we need to open up or increase our currency swap lines. We need more dollars immediately. And the Fed will say, no problem. And basically now, it's just an entrance on a keyboard. So the Fed can literally at the stroke of a couple key clicks on a keyboard and a mouse click, maybe there has to be some type of approval from the Fed president or something like that. I don't know all the details, but it's a very quick process now. And the Fed can just literally credit the European Central Bank with an extra trillion, 2 trillion, 3 trillion, $10 trillion. And this is the system that we now have since 2008. And this is what has been putting out fires in, whether it's temporarily trying to slow down the Eurodollar market from collapsing everything. When the Eurodollar market's 15 trillion, still a pretty big number, but it's not the size of the over-the-counter derivatives market. It's not the size of the credit bubble that China's created in just the last 10 years. China's created a lot larger credit bubble than the Eurodollar market, and you know what? China's credit bubble's still freaking growing. And a lot of that money has not stayed in China. A lot of that money's gone into real estate markets all over the globe and caused real estate bubbles or reflated old real estate bubbles. It's also caused commodity prices, base metal prices, to be a lot artificially higher than they should, in my opinion. There's enormous central planning in China. There's massive misallocations of capital. There's buildings falling apart in China as soon as they're built. No one's going to prison for fraud or killing people that die in these buildings. There's over 65 million empty houses. China has an enormous debt problem now, okay? 10 years ago, wasn't a problem. 10 years ago, China had hardly any debt in their economy. They did have some debt. It was tiny, though. It was really bad debt, but it was nowhere near the levels it is now. And over the last 20 years, Chinese household debt has exploded. Debt from Chinese state-owned enterprises, it's over $2 trillion US in dollar-denominated debt. This is not RMB debt that can be inflated away. So currency swaps are now the preferred method of putting out problems in the global economy. In fact, the press release that Steve Mnuchin put out, he handled that very sloppily. Currency swaps were probably what was used to paper over whatever problem there was. And I think there was a problem. And we may never find out what it was. It may take decades for us to find declassified government documents, or maybe someone leaks it. I don't know. Now, reverse repos and repos, the person who emailed me also asked about that. These seem to be liquidity tools to either add liquidity or remove liquidity from the system. However, the largest amounts of these things that I've seen is in the hundreds of billions of dollar range. So these are liquidity pumps or liquidity vacuums that can either inject more emergency liquidity or take it away. But these are not to the level of the currency swaps. These are not to the level of QE. Although now there is so much public backlash in a lot of places with QE because it is causing stagflation and taxes to go up. I have the definitions for repurchase agreements, reverse repurchases, and how central banks use them in the Investopedia ones. I'll attach links to them in the information section after the show's over. Don't want to spend time reading them right now. But basically, they're tools, they're supposedly monetary policy tools that the central banks can use to either add emergency liquidity or remove liquidity. But, like I said, it's all about size and scale. The largest repos and reverse repos and things that I've seen headlines for them are only in like the hundreds of billions of dollars range. For the purposes of discussion, these are nowhere near the levels of QE programs and nowhere near the credit that China's added in the last 10 years to the global economy, and also nowhere near the currency swaps. And the largest and fastest way for emergency liquidity injections that I found is by far the currency swaps. And in fact, GATA, Gold Antitrust Action Committee, had a story about this about a year ago. There was actually a brazen speech from someone from the New York Federal Reserve at a Bank of International Settlements conference, and he was bragging about how the Federal Reserve has had, these emergency currency swap agreements and how much they're increasing. So this is just in the last year or two. They're not even really trying to hide this stuff anymore because the average American doesn't even know what the Federal Reserve is, doesn't know what it does, and doesn't really care. And meanwhile, this is very, very inflationary. We need deflation in the real economy. The average person in my generation or younger who's an adult, works their ass off, is not going to be able to buy a lot of assets. There needs to be deflation. Food prices and these other prices need to fall. There needs to be a real cleansing of the system. It's not being allowed. So I started watching yesterday. I recommend this on Netflix. I found this. There's a really good documentary series. There's 6 episodes. The guy who does the series is politically biased, but he has done excellent investigative journalism on this. It's called Dirty Money on Netflix. And one of the episodes is about how HSBC knowingly laundered money as part of their business model for over 10 years for drug cartels and known terrorist organizations. So I would check that out. It doesn't mention James Comey in there, and he was paid lots of money to get the criminal charges dropped. And by the way, the bank admitted to the criminal charges. However, they were only fined $1.9 billion. So they made $40 billion in profits, and a lot of it was from laundering that money, knowingly, intentionally. They admitted to it, criminal charges. And they only paid a $1.9 billion fine, and the criminal charges were dropped. Why? Because in the Obama administration, there was Eric Holder, there was Loretta Lynch. Before she joined as Attorney General, she was involved in like one of the southern districts of New York as a U.S. attorney. She was involved in getting the charges dropped. There was a press conference, and there was a couple other people involved that you would know. Just really sad. So China is responsible for an enormous amount of liquidity injections in the last decade. And right when the U.S. stock market was close to collapsing, right when the Chinese stock market was in a long dive, they came in with around $900 billion of liquidity injections. And that reversed things. And now the Chinese stock market's going up a lot. And this is despite the real economic data, a lot of the anecdotal evidence and real economic data we see out of China that things are getting worse. That car sales are down a lot, that a lot of other data in China is getting worse, and yet stocks are going up, margin debt in China is increasing. China's learned the manipulation game very well from the US. China now just announced, I think last week, that they're allowing the People's Bank of China and the Chinese banks are extending tens of billions of dollars in credit for share buybacks. So I have these articles about the definitions of repo agreements, reverse repurchases, and 5 articles about Chinese liquidity injections in recently and their debt problem. So when Jeff Snider says the euro-dollar is causing all the problems in the global economy, it may be causing some problems. It's a piece to the puzzle. It's a $15 trillion piece, which is a pretty significant size piece. However, it is not the largest piece. And he is framing everything within a euro-dollar perspective, a euro-dollar glasses, euro-dollar colored lenses. And this is not the right way to look at things. The central bank to central bank currency swap lines that the Fed can implement to the European Central Bank, that they can implement to other foreign central banks, that they can implement to the Bank of Japan if need be. These things are dwarf the size of the euro-dollar market. And they could basically create credit. They can create about $1 trillion or $2 trillion within 10, 15 minutes. A phone call and a couple entries and a keyboard. And no congressional approval, none of that. And the majority of this inflation, the money and credit creation, has gone into asset prices. But the real economy is suffering from stagflation and taxes are increasing. So since 2008, the main parts of the rules changes that have kept the system alive are accounting fraud from the corporations and companies, the banks allowing their accounting rules to be changed. They don't have to mark to market. You have all these new liquidity programs. You have quantitative easing. You have share buybacks. And then you have stagflate and lie. Oh, and also fake economic data, the currency swaps, and negative interest rate policy. So a combination of these like 6 or 7 different things is why we have the system we have now and why everything hasn't crashed. And like I said, my views have changed a lot since I started doing this podcast and started doing videos and things like that. A lot. And I'm actually starting to wake up more Austrian school economists there. Some of these guys are having some really difficult conversations with me about China. Not Peter Schiff, though, because he thinks he's right about everything. But I respect people like Peter Schiff. I respect people like Jeffrey Snider. I've just outworked them. Now, maybe they're good at building their businesses or whatever. And maybe they're getting paid a lot of money to stare at a couple Bloomberg screens. And study a specific market or two, or only read and learn about a specific market, but I've studied a lot of different markets, and I've studied a lot of different people's opinions about the global economy, the derivatives market, all these things. Okay, I'm glad you guys like this so far. The velocity of money in the real economy, Jesse, is what has prevented hyperinflation. So you can have stagflation with that much money in credit, over $65 trillion, and there was stagflation before, but it's increased a lot. You can have stagflation with velocity of money falling because there's so much more money in credit chasing the same or fewer goods and services. And that is why we haven't had hyperinflation yet, is because velocity of money has fallen. So you can have stagflation, worsening stagflation, stagflate and line taxes for a long time, as long as velocity of money doesn't pick up. But we could see with what China is doing is very dangerous, because they're almost at 300% debt to GDP now. And before this is over, I think they're going to go to 500% or larger debt to GDP. And China is very close to running full twin deficits, a budget deficit and current account deficit. And their reserves are down a lot. Kyle Bass says that their reserves are way below $2 trillion now. If he is right, China's in big, big trouble. They're not going to be, their currency exchange rate's going to have to be fall a lot against the dollar, which is going to create even more inflation in China. And from what I hear, some of my sources, someone just messaged me a couple days ago. He is in China right now. He's not from China, and he's visiting there. And he was saying he's been here a couple months, and he notices food price inflation already in just a couple months, that the food prices are going up there. And I've heard exorbitant stories of rent costs in a lot of the tier 1 and tier 2, even tier 3 cities. Rent costs in China are up a lot. And the debt situation, the perception is that people don't have debt in China. A lot of families don't have debt, but that's not true anymore. And a lot of the debt has been used for real estate speculation and to buy mortgage properties outside of China as well. Well, Jason Townsend says hopefully hyperinflation by $200 trillion on balance sheets if possible. I think there's an argument to be made that the asset prices have already hyperinflated. So I heard something very interesting about U.S. stocks on the S&P 500, and that's that the price to sales ratio is actually double what it was in 1999. So the PE ratios actually look reasonable. The PE ratios do, but that's all because of the share buybacks. I think there's almost been $5 trillion worth of share buybacks just in the last 10 years, an enormous sum of share buybacks. So the share buybacks make the PE ratios look reasonable. Meanwhile, the price to sales ratios and other stuff, they can't fake those. And with a lot of companies, their revenues are down. So they've had higher earnings, but their revenues have not grown a lot. American Expat asks, how long until they destroy crypto like they've destroyed gold and silver? So they can't technically destroy crypto. I just finished the Bitcoin Standard by Safadine Ammous, and so he talks about ways that Bitcoin could technically be ruined, but none of them have been achieved. There's not a supercomputer yet to break it. The 51% rule doesn't appear that it can destroy it either. It looks like what the governments want to do is just tax people like crazy. So if Bitcoin goes up a lot, the taxes, there may be an extra like windfall profits tax. So if Bitcoin were to go to like over $20,000 or back to 20,000, the governments may decide to implement a windfall profits tax. But there's ways people can get around it. It's just might not technically be legal, but I've heard Bitcoin people say that they're prepared to leave the US or the country they're in if the country decides that they want to try to tax all their Bitcoin gains away. So I don't think governments can fully shut down crypto, but I think what they can try to do is hurt the crypto exchanges, like force transparency over what the customer's name and address and all this stuff is, and then also try to tax it. So they can't fully shut it down, and they're also going to try to copy the blockchain technology for government crypto like the Fed coin. So then they just add taxes. And they could add a bunch of different taxes. So if I keep doing this podcast, they could tax me more. They could say, you're a dissident, we're taxing you at a higher rate. So a lot of the financial community, including a lot of Austrian school economists, people who believe in the Austrian school, refuse to acknowledge the currency swap stuff. But we have had some people awake to it, like Nomi Prinz. I've had long discussions with. Grant Williams of Real Vision TV has acknowledged it. He had a long discussion with Raoul Pal about this a while ago. So there are some people that are acknowledging this. GATA covers a lot of this. Gold Antitrust and Zero Hedge cover some of this, but the majority of people in the financial industry refuse to acknowledge it. And they tell me they know what a currency swap is, and then I try to grill them, and they don't know. But right now, China is also in the currency swap game, but it's mostly to like, it's on a much smaller level. It's to like Southeast Asia, Africa, South America. It's in the billions or tens of billion range. Like Venezuela borrowed a bunch of RMB currency swaps, I want to say like 3 or 4 years ago, and I doubt they paid them back. So China is going to go after them. But the U.S., though, with a currency swap, the U.S. would get yen or euros, theoretically, with a currency swap, but the U.S. doesn't need yen or euros in a currency swap. So they would swap back currencies at the agreed-upon exchange rate, and technically the ECB or the Bank of Japan would have to pay them back. But if the Fed wanted, and this is where things get really angry for me, the Fed could just clear the loan and waive it. Because the Fed doesn't need the other currency. They have the world reserve currency, so they don't need the euros or the yen. They don't need that. And then they could just waive the terms of the loan and just say, the loan's canceled. You can keep the dollars. Which I think is what's been happening in Europe. European Union, European Central Bank, based on what my source brought me, the European banks, Deutsche Bank and others, that's how they've been alive. They've been zombies. The European Union governments have been zombies for a long time. There was no real recovery from Europe in 2008. They weren't even supposed to do QE. They only started that a few years ago, and that was breaking their own bylaws. They were never supposed to do that. And here we go, the European Central Bank now has over $5 trillion of QE already publicly stated on their balance sheet. Mario Draghi will probably be gone by the end of the year. He will get out before the train crashes. He will jump off the train. And looks like the ECB is going to continue with QE. Andy says, debt jubilee. The problem with the debt jubilee is a lot of people are holding the bonds as assets. A lot of people need it as good collateral and interest payments. So I don't know how that's going to get fixed. You have a lot of pension funds here in the United States that are holding treasuries now as investments. So what happens if you wipe the debt? The pension funds are in enough problems with corruption and getting screwed over by Wall Street, bad investments. Okay, well, this is pretty much all I wanted to cover. Let me take a look at my notes, make sure I got everything covered. Yeah, so my educated guess is that when Jeff Snider says that the Eurodollar market broke and commercial paper and stuff broke, I believe currency swaps came in and helped paper things over. I wouldn't say fix things. You can use air quotes and say fix things temporarily, make things look better. Because of how quickly they can do currency swaps, the Fed can, to other central banks, and it doesn't require congressional approval. They don't have to show it on their balance sheet. And it just looks like the preferred method of liquidity now and covert bailouts. Backdoor bailouts. Because the people, look at what's happening in France with the Yellow Vest protests, the people are getting pissed about banker bailouts. Okay, guys, well, that's it for now. I will answer other questions when I have time under the video after it's over, and the articles that I briefly touched on will be in the information section. So hopefully this answers the question for the listener who sent out the emails. Like I said, I didn't want to spend all the time typing because I have pretty bad arthritis now in my fingers and hands. And it's just easier for me to do a podcast about this. And this is based on 10 years of enormous amounts of research, interviewing different experts, reading a lot of different books. And I've had dinner with Nomi Prince and in person one-on-one and discuss this. So thank you for your time. Hopefully you learned a lot about this. And now if you want to refer your friends to what's going on with this stuff, this hopefully will be one of the definitive shows.